Yeah, I mean, Bitcoin and crypto have been disappointing because they really took it in the gut in mid-October and then kind of got hit again when you're right, when the odds of a Fed cut dropped, Bitcoin fell. And then now that the odds have recovered of a cut,
Yeah.
they haven't quite recovered. I mean, I think that that's still the lingering effects of that deleveraging that happened on October 10th. It's not that different than the wipeout that happened in 2022 with FTX. That took 8 weeks. So we're kind of emerging from that. That's 7 weeks in the rearview mirror. So maybe in another week or two, I think crypto has fully washed out, and that's when it starts to participate.
Yeah, wipeout's a bad word.
Bitcoin Zella stands out with its simplicity and clarity. We've crafted an experience that anyone can dive into, whether you're a crypto expert or just a new to the crypto world. Now, guess who keeps his eye on us? The author of best-selling book Rich Dad Poor Dad, Robert Kiyosaki. And we want to take this opportunity and thank all the people who trusted us, and we read every comment. And the best part, it's free. Subscribing now means you will get all new information for free. Don't just follow the trends, stay ahead of them. Subscribe to Bitcoin Zella today and enjoy the new edge.
Tom Lee explains why December's rough start could trigger a powerful year-end rally, so keep watching to learn more today.
Yeah, in fact, I think it was looking good, like you said, over the weekend, and then we got a decline, sorry. Maybe because the Bank of Japan looks hawkish.
Yeah.
But I don't think the 4-year cycle, I don't think the Bitcoin high is in place. But you're right. We were too optimistic about this happening by December, but I do think Bitcoin can make an all-time high by the end of January. So I don't think we should think the highs are in place for Bitcoin or Ethereum or crypto. So a lot of it's going to depend on equities recovering, which we expect it to, and that helps the animal spirits. And I think a new Fed chair will help. And we have, as Becky said, when people got worried about a hawkish Fed, that kind of hurts the discount models, the discounted cash flow models like AI models, but it hurts crypto models too. So if we have a dovish Fed, that's really a tailwind. I am. I think the biggest tailwind that's going to emerge in the next couple of weeks is around central bank. The Fed is set to cut in December, but also today is the day that quantitative tightening ends. And as you know, the Fed's been shrinking its balance sheet since April 2022. It's been a pretty big headwind for market liquidity. The last time we had an end to QT, quantitative tightening, was September 2019. And if you look back at that period, the markets really responded well. I think within 3 weeks rallied more than 17%. So I do think the timing of QT ending, which is now essentially QE starting, and the Fed, and at a time when November kind of was topsy-turvy, so I think people got cautious, but now have to performance chase, and then you have a really typically a seasonal tailwind. So I'm pretty bullish into December, even with maybe the first day being rocky.
A key Bitcoin valuation metric now suggests there is a 96% chance that BTC will recover strongly by 2026. Bitcoin is currently trading well below its Metcalf value, the fair price based on how many people are using the network and how many transactions are happening. Whenever price has dipped under this level in the past, one-year returns have been positive almost every time, hinting that today's weakness could be tomorrow's opportunity. Economist Timothy Peterson notes that this signal appeared in early 2023, right before a huge 340% rally that launched Bitcoin to new all-time highs. Now, network activity is growing again with more long-term holders, rising transaction counts, and renewed spot buying showing that adoption is expanding, not fading. Spot market data backs this up, with cumulative buy volume turning positive after weeks of selling pressure. Together, these trends suggest that the current drawdown looks more like a deep discount than a collapse, keeping the odds of a powerful 2026 comeback firmly on the table. For patient investors, this period may feel uncomfortable, but historically has rewarded conviction hugely.
I'd say that the shutdown put a blackout on data, and I think that created a bit of anxiety because, markets like visibility. But to me, the fact that claims have been behaving and the September jobs report kind of showed a bit of a recovery. I think the labor market's probably holding fine, but the Fed doesn't want that to worsen. But I think the inflation story is actually weakened a lot. So to me, the Fed would be cutting for the right reasons, which is as they look at the next 12 months, the tariff inflation impacts are fading, but there's risk on the job market. So, I mean, I think it's cutting for the right reason, which is, real rates are tightening if they don't cut. Yeah, I think there was a bit of soul searching, Becky, in November, because we know leverage rose. And we know there was deleveraging in some markets like crypto, and we know margin debt's high. And I think that there was essentially a reset in November because the market had a 6% decline, but the AI stocks and the meme names and a lot of other names fell even more. So I think that position reset has been healthy, and I think many fund managers we talked to in November, in the midst of all that, kind of threw in the towel, thought the rest of the year was sort of a write-off. And now if December is strong, there's going to be a bit of performance chasing. And I think that's what you should typically expect in the final weeks of the year.
I thought it was,
yeah, I mean, 7,000 is only 2% for S&P. From here, I think 5% or maybe even 10% is possible in December. So I think a 7,200, 7,300 is likely for S&P.
ask you not to do that. You're giving me a target and a time. Don't. It's not good for your career. Don't do that. You're going to be wrong one of these times, but you don't care, do you? You've been right enough.
Well, I'm just looking at probabilities, but you're right. We've been wrong plenty of times, Joe, so I'm okay being wrong too.
Okay. I never have been, really.
Yes. The markets don't want the Fed to lose credibility, and the bond market will kind of protest if the Fed is too dovish. But I think when I look at Fed fund futures, especially implied inflation, the bond market's more dovish than the Fed. So it looks like the Fed is behind, and that's why I think cuts are necessary.
Are you in town? Where are you?
Yeah, it's pretty. I was just thinking. The
I'm actually in Tokyo. Otherwise, I'd be visiting with you in
magic.
person.
That's magic.
Bitcoin is wrestling with the key $50,000 level just as the U.S. Federal Reserve quietly injected $13.5 billion of overnight liquidity into the system. That move effectively marks the end of the latest round of quantitative tightening and delivers the second largest liquidity boost since the COVID-19 era, a classic green light for risk assets like Bitcoin and stocks. Traders now expect the Fed to start cutting interest rates from its December 10th meeting and continue easing into next year, even as worries about Japan's financial stability hang in the background. December is already known as one of the strongest months for equities, and fresh liquidity has stock market bulls firmly in control. Crypto, however, is telling a more complicated story. Bitcoin has lagged behind stocks, and some analysts warn it could be the first to signal a broader risk asset pullback. Bloomberg strategist Mike McLone points to Bitcoin's lofty valuation versus gold and argues that a reversion towards fair value would put BTC closer to $50,000, making the current battle around that level even more important around the world right now. If you have been watching so far, thank you so much for watching, and do not forget to subscribe to Bitcoin Zella for daily news all for free. That's all for today's video. Until next time,